Anyone who has been through a recession understands how damaging it can be to one's finances, regardless of their income or work situation. As a result, planning for a recession is a good idea for your financial security. Because it's hard to predict when the next recession will strike, you should begin preparing for it now. The world is a scary place, and earning money is never a guarantee. You must always be working to improve your financial situation. It's the same piece of advice you should follow in general. Prepare yourself. The greatest strategy to prepare for a recession is to keep track of and improve your financial situation while the economy is still doing well. The list of things you should do to enhance your money is short, and creating smart financial strategies isn't difficult. Number 1, put money aside for an emergency. The major issue that a recession poses is that it may cause some disruption in your earnings. An emergency fund might help you get through a difficult period if you lose work unexpectedly or have to live on a lesser income. If you don't already have an emergency fund, start one immediately with a high-yield savings account. If you already have one, consider expanding it. To safeguard yourself from a drop in income or job loss, you should have enough savings in your emergency fund to cover at least 3 months' worth of costs, 6 months if you have children. Boost your savings budget as much as you can after cutting out unneeded costs. Savings should account for 20% of your income, while additional costs such as subscriptions and memberships should account for 30%. Set up greater automatic contributions to your emergency fund after you've reduced your additional costs. If you lose your work or have automobile problems, your emergency money will come in handy. The most vital point is to keep your emergency fund liquid, whether it's in a traditional bank savings account, an internet savings account, or even a money market account. During a recession, you don't want to be pressured to withdraw money from the stock market. Number 2, pay off your debts. Paying off debt is a critical way to secure oneself when a recession approaches. Debt is a major drain on your budget, as it is an ongoing cost for you which you receive no benefit. The more you can pay off now, the better prepared you'll be to survive a downturn when it comes. When the recession strikes, this helps to raise the amount of excess money you have on hand. This is the most effective risk management technique, and high-interest credit card debt should be paid off first. Try refinancing or merging your debt at a reduced interest rate in addition to allocating available cash to debt repayment. This can help you save money by lowering your interest payments, lowering your monthly costs, and freeing up funds to save or pay off more debt. Number 3, look through your investment strategy. It's critical not to allow the threat of recession influence your investment choices. To put it another way, don't try to predict the stock market. Rather, prepare for a downturn by practicing healthy behaviors all the time. Create a well-thought-out investment strategy and adhere to it. People's best bet right now is to double-check that their portfolio is suitable for them. If it's too dangerous, you should make modifications right away. Make sure you've got the correct investment mix. Most people have been investing actively in equities in recent years as the stock market has gone incredibly high. Now is the moment to consider how you would react if the market dropped 20% in a year. Be fair. If you feel you can withstand a loss of this size, adhere to your strategy and stay on track when the market collapses. Hang on to your assets, especially if you're young, since time is on your side and losses in a stock-heavy portfolio may be recovered over time. Alter your plan for peace of mind. Your risk appetite should be reflected in your portfolio. If you're worried about an economic recession and think huge losses in your retirement funds would keep you up through the night, now seems to be the chance to reorganize. Consider the following strategy. 70% of your money is invested in equities and 30% in bonds. If you fear you won't be able to withstand a significant decline in the stock market, now is the moment to switch your asset allocation to, say, 50% equities and 50% bonds. But don't wait for the market to crash before making a move. You can make some tweaks when you're not sensitive about it, when it's not free-falling like it was in 2008 or 2001 to 2002. This is because you can now determine whether there are any weaknesses in your portfolio that may be exposed to market risk due to the lack of diversity. Number 4, add a side hustle to your revenue mix. We generally think about diversity in terms of our financial portfolio, but the concept can and should be extended to other sources of revenue too. Considering one of the most serious concerns during a recession is a loss of income, having numerous income channels can assist to buffer the impact of a drop in revenue or a job loss. Lots of people in the United States hold a second job. If you don't have one, this could be a good time to start. Just do a little study and find a side career you can start right away to safeguard yourself from future income cuts. Regardless of whether the economy is headed to a downturn, consider beginning a side hustle to augment your income. Spend time writing an ebook, an online course, or a blog on a talent you've perfected and might use to generate passive revenue. For an added financial buffer, direct deposit your side hustle profits into your savings account. Number 5, lower your daily spending. Every month, review your budget to determine what costs may be eliminated. Are you overspending on clothing? Remove them from your picture. Don't wait for the downturn to act. Now is the moment to cut the fat from your budget. Examine both your set monthly payments and your personal expenditures. Examine what you can go without and minimize or downgrade services that are just not essential to your family's well-being. Try becoming more modest with your leisure expenditures in order to save money and pay off debt. To save a few dollars, just buy what you really need and choose generic over name brand items. Number 6, evaluate your current job and employer. Don't just keep an eye out on national economic circumstances while preparing for a recession. Take a better look at what's going on in your neighborhood. Know how well your employer is doing financially, since it may help you properly estimate your risk. Changes in your corporation and sector have a greater impact on you than what occurs on a national level. Employees of publicly traded companies can keep up with company and industry news by listening to earnings reports. Also, employees should identify strategies to protect themselves against a prospective job loss in addition to understanding the health of their firm. So it is highly recommended to take efforts in your existing job to raise your worth to your firm, such as expanding your knowledge and abilities and taking on more tasks. To improve your CV, use free online learning resources like YouTube, expert guides, LinkedIn courses, and assessments. Show off your abilities during meetings to demonstrate your worth to your boss. Add any certificates you receive along the road to your CV to demonstrate your desire to study. Boosting your own worth and earning potential may be achieved through improving your abilities. Join events and conferences once a month to polish your digital and in-person networking abilities. Interact with industry experts to promote your services, hear from them, and form long-term business relationships. These contacts might lead to job chances or professional business advice in the future. Number 7, save money for short-term aspirations. It's time to change gears if you've put money into the market for short-term goals like roof repairs or automobile purchases. That money should be stored in an interest-bearing account to protect it against stock market fluctuations. In any event, this should be the case. Folks have been a little overly ambitious in recent years, saying things like, "Oh my gosh, I want to own a house in 5 years, so let's be very adventurous and throw it all in the stock market so it can increase." They can increase in size, but they can also decrease in size. Number 8, don't make decisions based on fear. Recessions may be stressful and terrifying. People respond on the basis of impulses and anxieties, according to financial advisors. We tend to purchase on greed whenever the market is rising and sell on fear whenever the market is falling when we are sensitive. We would be doing the complete opposite of what we need to do to earn money in the market if we purchase high and sell cheap. A recession is an inevitable feature of the business world because another economic upswing will merge when the recession passes, so you must retain a long-term view with your retirement resources. Avoid making emotional financial decisions whether your investments are performing well or poorly. Consider riding out any downswings if the market goes off the rails for the worse. Before making any big adjustments, consult with a trustworthy financial advisor. The bottom line, whenever the next recession strikes, don't worry or let your feelings get in the way. Rather, plan ahead of time and you'll be able to relax afterwards. Adopting these smart financial methods will help you enhance your budget and prospects regardless of the situation of the economy. Tracking your budget, making regular adjustments, Building an emergency fund and looking for ways to enhance your experience are the greatest ways to boost your savings and prepare for unforeseen occurrences. While exercising healthy financial practices, you may improve your savings account and career. What else would you like us to talk about in our upcoming videos? Let us know in the comments below. And make sure to subscribe and turn on notifications so you don't miss out on any of our videos.